Okay, so Pankaj, what's the ideal portfolio construct? What we'll do is we'll try and, since we are in that topic, let's figure out the current times. Then I would love to, in the second segment, talk about the basic investment philosophy as well, which might be time tested and stand the test of time. But since you're on the current topics right now, let's talk about that. How would you therefore build out a portfolio in the current times? Is there cash that you would sit on? If not, where is it that, would it have a more defensive bent? What are the themes that you would largely focus on?
So I think 3-4 themes, Neeraj, which probably are looking okay. One, I think, is the entire private sector financials, which I've been talking about. I think for the last couple of years, you saw a very sharp disconnect between PSUs versus private. I think that big rally in PSUs is behind us, and incremental earnings growth should not be too different for a PSU versus private sector bank. And I think last couple of months, you have started to see that shift happening of capital happening from PSU to private sector. So I think that's one area where one should keep focus on. The second is, I think, the entire consumption basket. And incremental R channel checks suggest that things have started to improve on the consumption side. But it's a very, a different topic, because the consumption basket over the last decade, it has gone through a massive change. About 6.5 to 7 lakh crores now is getting spent on things which were not existing a decade back. For example, smartphones, wearables, OTT, mobile data. All these things which were never a part of your consumption basket has now become almost $80-90 billion. And I think we need to be very careful on the names we kind of move on to the consumption. But initial signs, consumption is picking up, and a close eye on monsoon. I think that should be a space where volume growth has been absent. Last 4 years, people have seen time correction in the stock. And probably if earnings growth starts to pick up, I think that segment could be quite okay. And it has to be a mix of both rural and urban discretionary. The third is the auto ancillary. And I think the play there is both the underlying domestic auto industry picking up, plus the export opportunity which is getting created. And many companies in this space, when we are speaking, there are two big changes happening in this space. One, India is becoming a domestic hub for their other factories across the globe. And many companies which are part of that are seeing that benefit coming from an export opportunity perspective. And the second big change which we are seeing in some of the auto and industry companies are that they are also moving towards industrials. So today, for example, an auto ancillary company, almost 80-90% was autos, 10-15% was non-autos. That 10-15% is becoming 40 to 45% over the next couple of years. And hence you can see a significant multiple re-rating, because you will de-link yourself from the auto side. So that's another space which is looking good. Pharma is again looking very decent in terms of both valuation as well as the earnings growth story. And we believe that the US generic cycle, the 10-11% price erosion which you were seeing, probably is now come down to 3 to 5%. And you could see earnings upgrade happening on the pharma sector as well. So these are some of the areas and pockets which are looking okay. We are keeping a very close eye on specialty chemicals also. I think we have seen a very sharp price erosion as well as time correction in many of them. We believe that the agri cycle is bottoming out. And from there, if global agri restocking starts to happen, many of these specialty chemical companies could probably benefit as you go back. So portfolio has to be today diversified. You can't take very significant bets on a concentrated right now, because a couple of bets going wrong can see whatever returns you have made over the last couple of years getting diluted. So it's time to be a risk manager more rather than a fund manager, and make sure that you are in those stocks which, if it corrects by 20 to 25, 30% in any given day, you are able to average it out. Many a times we see that, how Bhagwan, people, the company becomes good when the prices and you don't have that confidence to buy at a lower price. I think this is a time to be fully convinced that if you're buying any stock, be mentally prepared that it can see a price corrections over and at a lower price, can you be able to average it out? I think these are the some things which you need to keep in mind when you navigate the market over the next 12 to 18 months.